Well, I think, first of all, it's too soon to say that the markets are really stabilizing. I mean, the Fed basically threw in everything plus the kitchen sink by saying that they were going to engage in unlimited purchase of treasuries, of mortgage-backed securities, of ETFs, of bonds, of almost anything that moves. So I think it was to be expected. Finally, the market responded positively to what the Fed did, because in previous announcements, the market did exactly the opposite of what the Fed was hoping would happen. So yes, we saw a very nice bounce yesterday. That seems to have now leveled out today. We'll see what happens in the next few days. I think it's too soon to say that this is the bottom. The comparisons to 1933 are interesting to say it was the best day since 1933. But that's, of course, very troubling as well to have to make those kinds of comparisons. I mean, just a few days ago, it was looking like we were tracking the 1929 crash quite closely. And if we carry on this path, that will be sort of the scenario that we're looking at. So these comparisons to the 1920s and 1930s, I think, are more troubling than anything else.
Of course, it's always dangerous to try and dig up previous histories of markets and try and force that template over where we are currently, Octavio. I just wanted to, though, reflect on that 29 to 54 period where in nominal terms we effectively did not see the markets regain a previous high. Nobody seems to think that it will take that long for a rebound in these indices once we have this virus under control here. But I do wonder, given there were concerns about Japanification anyway, and a lot of additional stimulus has been thrown at economies and markets, whether there is actually such a risk that it takes a whole lot longer than people think for us to retake previous highs.
Well, I think the comparison to the Japanese market is very interesting. I mean, they haven't come close to the highs they had in 1989. So there we're talking about a 31-year period where if you were unlucky enough to put your money in the peak in late 1989, you would have lost about half your money now over 30 years later. So these things can take a very long time to come back. I mean, we certainly see that with the US equities going back to the 1920s and 30s. We've seen it much more recently with the Japanese equities markets. And frankly, if you look at many European indices now, we're in many cases at levels we were at 10 years ago, maybe even more. So that is, I think, something you have to take into account. And that's, of course, going to spook away a lot of investors, especially retail investors, who are looking at that and saying, I just don't have that long a time horizon. I mean, eventually the markets seem to come back, but it can take decades. And so that's going to trouble and keep a lot of investors on the sidelines for some time to come, I think.
Octavio, I want to take it back to central banks and the measures that we've seen taken by the Fed, the ECB. Obviously, the market is suffering in the wake of those decisions, but now we've seen a rally. Do you think that the market underappreciates the action taken by the central banks? And perhaps another leg to that question, are these the right steps being taken by the central banks, or are these the measures that they are, really responding to the last crisis and they're using the same learnings from that or teachings from that to apply them here in a very different situation?
I think you're absolutely right. I mean, the playbook they seem to be operating under is basically fighting the last crisis, which was a financial crisis and a credit crisis. And that would be true in 2008 and then 2000 when we had the dot-com bubble. These seem to be more sort of financial crises by dislocations in the credit markets and soaring interest rates that led to these downturns. Here we have a very real parts of the economy shutting down, an entire country is shutting down. So there's no sort of financial, this is not a monetary issue or a financial issue. This is the real economy that's basically grinding to a halt. And that is something that monetary policy is not going to be able to address. I mean, monetary policy can create some inflation in terms of asset prices, no question about it, and they can create some nominal growth in terms of where the markets are. But if you look at what's happening to consumer spending, it's absolutely ghastly. It's just falling through the floor. And that's particularly focused on particular sectors such as restaurants and travel and hospitality and things of that sort. We're seeing very, very negative numbers there overall. So lower interest rates and financial injections are not going to get people to go eat in restaurants. They're not going to get them to go into airplanes, and they're not going to get them to go onto cruise lines. So they really are fighting the last battle, as it were, or the last war with the same weapons. And it's hard to see how that's going to impact positively those sectors of the economy that have been hurt so badly.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.